Hey everyone, this is Charlie. Hope everyone's doing well and staying healthy. Today, me and my group will be representing Campbell Soup Company. So, what is Campbell Soup Company? Many of you may think of the red and white soup cans, but they're actually one of the largest companies in the processed food and snack industry. They did a lot of mergers and acquisitions over time, which resulted in them acquiring a large variety of brands. So, what will be analyzed is the previous and current financial performance, the environment and competitive situation, industry trends and forecast, strategy, and what the firm should do or continue to do to be successful. So, the end goal of all this is to give you our thoughts on if we should or should not invest in Campbell Soup Company. So for this industry, it's forecasted to grow at a compound annual growth rate of 3.86% over the next 5 years. And the reason behind this, Mortar Intelligence believes that the driving factors are growth in urban population and an increasing demand for easy and convenient food. So now we'll be off to Jack.
Before we decided to invest in Campbell Soup Company or not, we needed to gain an understanding about the industry environment Campbell Soup Company is in, and that industry being the food processing industry and canned goods. So we use Porter's Five Forces model to assess the attractiveness and profit potential. These five forces include threat of new entrants, supplier power, buyer power, level of rival intensity, and threat of substitutes. Uh, After assessing all these, we conclude that there's a moderate to high industry attractiveness and profit potential that Campbell Soup Company is in. Of these five forces, three of them strengthen the attractiveness and profit potential. Those are the low threat of new entrants, the low supplier power there is, and the low buyer power. And the other two forces weakened our argument and made it a little less attractiveness in the industry, and those included the high level of rival intensity and the high threat of substitutes. Of the five forces, there's two forces that led us to believe that this is a really attractive industry. Uh, those two forces were the low supplier power and the low threat of new entrants. The low supplier power was based off of the amount of suppliers in the industry and the lack of differentiated um, items that the suppliers provide to the firms that are making all these different types of foods. And next, the low threat of new entrants is based on the economies of scale because all these firms in this industry are very large and about the same size. So a new company coming in would have difficulties producing those low cost goods because of the lack of economies of scale and capital requirements. And they'll also have trouble getting into the industry because of government policies and trying to differentiate themselves from all the firms that are already in the industry. And now Justin will talk about the business level strategy of Campbell Soup Company.
Campbell uses a cost leadership business level strategy. This strategy puts an emphasis on low cost products while reaching all areas of the market. Their product line varies from hundreds of different types of soup to many different types of cookies. The goal for this business is to produce cheaper options than traditional meals. For example, the average price of a can of soup is less than $3, and they also price their snacks and other food options at very affordable prices. Campbell's uses a consistent packaging across their product line and doesn't deviate even if the product is a different flavor. The consistent branding is great for customers to recognize their products. It is also great for economical reasons. The company can purchase inputs in bulk and save money, and the company can produce more using the same internal resources, thus achieving economies of scale.
As we look at the competitors, we can tell there's a distinct difference between the top four brands and the others. The top four being Conagra, Kraft Heinz, Bolton, and Campbell's. The top four are relatively the same size, but as mentioned in the 10K report, some of Campbell's competitors are larger and have the ability to offer substantially higher financial and marketing resources. And so the question that comes with this is, how can Campbell differentiate themselves? One is brand loyalty. How do they create that brand loyalty? Through relationships. The relationships are important to create because that's where you're going to get your income. That's where you're going to get the money associated with your products. And second, prices. As we mentioned in our report, Campbell sets low prices and tries to differentiate themselves from the competitors in that way. When we look at the financials, we looked at 4 areas in which we thought were important in understanding the financial outlook and whether the ultimate question, whether investors should or shouldn't invest in Campbell's. As we look at the table, we can see net earnings, and we did the last 3 years, so from 2019, 2018, and 2017. So in 2017, net earnings for the company were $887 million, and then we had a very big drop off to 2018 and 2019. It decreased all 3 years, but we went to 261 to 211. Some of the explanations for that were the divestitures that the company had. They kind of slimmed down, got rid of segments of the company in which they didn't really see it as profitable anymore, and so net earnings could be explained that way. But as an investor, you should be wary that net earnings, or the bottom line, has gone down each of the past 3 years. As we move to debt to equity, is used to evaluate a company's leverage. The Harvard Business Review explained it as, okay, how much does a company use debt to run its business? And so we have the ratio here. In 2017, we didn't have the information for 2017, but 2018 and 2019 we did. And so I guess an important note would be, okay, what's the average debt to equity ratio? And it's okay to have debt to run a company. A lot of businesses have debt to run a company, but at the same time, you don't want to use too much debt to run your company. So for Campbell, in Campbell's case, 2018 was at 9.64. So around there, a standard debt to equity ratio is around 6 to 7. So 9.64, you might see, okay, it's kind of high, but at the same time, it's not too high. But the statistic that we should be wary of is the 2019. It's gotten worse. It's reached double figures. We're at 10.91. So yeah, debt to equity ratio there. Next, we move to earnings per share. And earnings per share is an indicator of a company's profitability. So for each share of stock, how profitable is it? In 2017, we had at 2.91, 2018 0.87, and 2019 0.70. So as you can notice, all 3 years it has continued to decrease the price of the stock. And lastly, we'll look at dividends. This might be the most favorable statistic out of the bunch for the Campbells from an investor's point of view. When it comes to dividends, it's important to kind of, keep it stable, keep it consistent. And so, as you can see, they have put out 1.40 million shares of stock. Dividends. They have sent out 1.40 million dividends to their shareholders, and so that kind of gives investors, okay, like it's consistent. Maybe it's a financially stable company from that perspective, but as you can tell, it doesn't tell the whole story. It can sometimes not be as transparent as it needs to be, and block the view of other statistical figures such as earnings per share, debt to equity. And that moves us to the recommendations. And so I have 3 recommendations. or we have three recommendations. One, their ability to compete. In order to do that, they have to have the ability to predict, identify, and interpret tastes and dietary habits of their consumers. Without that, there's no product to create and there's no consumer to buy. Next, they have to gather intel into which products could be modified or introduced into the market that would be able to satisfy their customers in ways maybe their existing products haven't. And lastly, for their ability to compete, they have to create and nurture relationships. They have to be able to create value at all stages of the buying process for the customer, whether that's samples, whether that's anything, getting face to face with the customer and making to create that relationship. Say, hey, like what do you all preference, and how can we adapt our product to meet your needs and wants. Second, capture growth. The business mentioned in their 10K report that they have seen an uptick in the amount of snacking that their consumers have done. And so one of the goals of the company, they have to keep it healthy. They have to keep it organic, all natural, because if their products are unhealthy, people are probably going to stop buying them, because if they are snacking a lot, could cause obesity and all of that. So they want to make sure that their products are relevant and that they're healthy and they catch the consumer's eye. And like I said earlier, they have to go to the consumer and see what they want. And next, research and development, just to create ways for consumers to show loyalty, whether it's the packaging, whether it's the product itself, like all of that plays a part in how the consumers view the company. And so just researching that and developing ways to create a superior product. And lastly, e-commerce. An increased amount of transactions happen over the internet nowadays. And so a lot of companies are transforming their advertising over the internet and providing products over the internet, and which transactions are happening that way. And so one of the recommendations is like increase branding over the internet, provide products that can be transported that way, whether it's besides traditionally, like supermarkets, grocery stores, all of that, and be able to create awareness about your product and how to buy it over the web.
So, with all this being said, if you're investing and you're looking for a decent return in a reasonable amount of time, I would definitely recommend looking elsewhere, and we would not recommend investing in Campbell Soup Company. We hope you guys enjoyed our presentation. Not sure how this works, but leave any questions for us, and we will get back to you. Thank you.